Hello accounts people, time to have a look at ratio analysis. So ratios are mathematical calculations performed on a set of financial statements. The calculation normally ends up in a percentage. The only two that are still commonly ratios, in other words something to 1, a current and acid test, but those could be percentages as well, so 2 to 1 is 200%. They're not covered by international accounting standards or IFRS or any law, so if somebody uses a formula, it's not an ethical or professional issue, they just have learnt a different formula. There are some commonly used different formulas for gearing and ROCE in particular. However, AAT have recognised that we tend to use similar ones. Most accountants by and large the same formula, and those are ones that are in the AQ 2022 syllabus and the publisher using. So calculate task 6, it hasn't changed from financial statements exam on the 2016 syllabus, and then write about it and explain having been given a percentage in task 7. And we will be identifying the pattern, has it improved or deteriorated. Higher or lower doesn't mean improvement, because higher could be improvement, could be deterioration. Better or worse is okay as well, but not as good as improvement or deterioration. We can then make sense of what's actually happening, or put in perspective, this is what the company had to do or the directors had to do, and this is the effect it's had, or we can see it showing. And we can also compare it with previous years, improvement or deterioration, industry average, we're higher or lower than the industry average, or we're better or worse than other companies. And then some of them help us to analyse what might be going wrong in the company. So different ways of learning them. Post-it notes around your computer or workplace, just doing more and more calculations, especially if you like writing out and you like writing out the formula for every calculation. Plenty of exercises in the publisher's books. Some students come up with rhymes, some students like a slideshow or loop in the background. A bit of subliminal learning, do that in class when students are working. Or some students get their friends or colleagues to test them, so nothing like a colleague at workplace shouting out what's the formula for this. May put you on the spot, but that's good exam practice, and you're definitely going to learn them if you know that's going to happen. Task 7, the written one, helps a lot of students as well, so once you've had to explain them, it helps you understand the formula and what's happening and focus on it a bit more. And then once you've learnt them, they'll come up again and again, as well as the rest of your life, including the options. We do have to use them with care though. Imagine you're sat at an AGM, a shareholder, you get your first look at the financial statements, you get your calculator out, you start doing the formulas. If you can't remember the formulas, you can Google them at an AGM, but you can't in the exam of course. Current directors may have had to deal with high levels of loans. They've only been appointed for a year, well they are year-to-year appointments, so therefore finance costs are high. So that's why we don't use profit after tax for ROCE, we use operating profits, which doesn't include the finance costs. But return on shareholders' funds is profit after tax, that's after tax and after interest. So it will show in the formula. So the need to finance may have affected the end calculations. If we issue shares, it will make several key ratios look worse or better. So for instance, ROCE, the operating profit could actually rise a little bit, and it'll be hidden by the fact that the equity has gone up, or if it was a loan, the non-current liabilities have gone up. Revaluations, well, revaluations of course aren't always done every year in exactly the same way. If your property has gone up over the last 20 years, it may be you've only revalued it a couple of years ago, so you had to bear in mind that the calculations of previous years didn't really have the right value of assets in it, and therefore equity. It just wasn't showing in the accounts, even though the land or buildings had been going up. So our first formula then, ROCE, the mother of all ratios. This is essentially what the directors have done with the monies available to them, which is the equity, the investments including retained earnings, and non-current liabilities, the money that's been loaned or debentures, and also preference shares. Similar theory, so if one goes up, the other generally goes up. Slightly different calculation though, but only for a few seconds calculations, it's worth doing both. Profit after tax, so that shows finance costs, but the bottom row is only equity, therefore not showing non-current liabilities going up. So RONA, return on net assets, very old fashioned. You can only really do it on sole traders accounts, and net profit is normally the same as operating profit, but you can of course calculate net assets from a set of financial statements. It's non-current assets plus current assets minus current liabilities. Then we're getting into the efficiency type ones, so gross profit percentage or gross profit margin. So gross profit is revenue minus cost of sales. Revenue, not sales of course, because we're getting into level 4 and we know the difference between revenue and income. So gross profit then, if you sell the same number of goods at a higher price, then your gross profit will probably go up, but if your cost of sales is going up, it will reduce your gross profit. Usually if you sell more goods, it means you've dropped your prices, but the revenue can stay the same. So, you know, it's playing around, trying to analyse what has actually happened, what could have happened. Now, by and large, operating profits, again, often operating profit margin, will follow gross profits. If gross profit is going down by 4%, your operating profit will go down roughly by 4%. The difference is, though, that we're now including all the other expenses, a lot of which are fixed in nature. Therefore, if there's a big change in volume, it will show more on the operating profit than it does on gross profit. But we can also use any particular expense against revenue. Maybe we've let admin expenses go out of hand, maybe the distribution costs have gone out of hand, and it will show part of the story. What's happened, why. Doesn't give you any solutions, it just tells you why and what's happened. So liquidity, these grouping, obviously gearing a financial ratio is sometimes called a liquidity as well. So these are two that are still usually to 1, the power of 1. So analyse them. Current assets is inventory, receivables, prepayments, and cash and equivalents. So a big change in this will be down to one of those. Obviously higher is normally more solvent, more liquid. However, if it's inventory and you can't turn it into sales, it's wasted assets. So going up a lot may actually be a bad point. A failure to control inventory levels or a failure to collect money in from receivables could be an increase as well. We also have the current assets minus inventories version, the quick ratio or the acid test. Because of that issue, it doesn't allow us to hide massive increases in inventories. And then our two inventories one. So inventory turnover is cost of sales. It should really be purchases, but we don't of course have a purchases figure on an IAS set of accounts unless it's in the notes. So we have to use cost of sales. It's how many times our inventories have been turned over during the year. Similar calculation, but it gives us the answer in days. So how many days are we sitting on our stock? Again, we've got to use cost of sales from a set of accounts because we won't have the purchases figure. Along with that one, these two go into the working cash cycle and they have similar issues. So again, when we're interpreting the calculation, we have to use the proverbial pinch of salt. Because we're having to use trade receivables, many people would prefer to use average receivables, and we have to use revenue when strictly speaking we should only be using credit sales. But you won't ever see a figure for credit sales in a set of accounts, so we have to use revenue. And you'd have to have several years of accounts to make sense of average receivables. But it tells us how long in days it's taking to collect money in from our customers. If it's going up, we've got bad credit control issues. If it's going down, we've either got better at credit control or we're doing lots of online sales. Similar issues with payables. Ideally we'd use average payables, but we may not have enough figures to do that. If we've only got 2 years, we can only do one numbers. We need 3 years to do to average payables. And cost of sales, we really should be using credit purchases or purchases, but we don't see that on a set of accounts, so we have to use the cost of sales figures. Cost of sales figures is a yearly product, of course. Payables is an end point in time as well. So not perfect, but better than no numbers, no calculations, no interpretation at all. And these are the three, those last three make up the working capital cycle. So inventory days plus receivables days is how long something's sat on the shelf, how long it takes to get the money in from our customers, minus how long we took to pay our suppliers for it. Shorter the better. Retailers often have negative working capital cycle. So a company like Tesco takes so long to pay their suppliers compared to how long the money comes in from their customers, because it's cash sales, of course. And obviously Tesco are good at keeping stock turnover as quick as possible. And then two financial positions, so the interest cover, so you made your profit from operations, that's before the finance costs in your accounts, in your profit and loss account. How many times does it cover those finance costs? You need it to cover your finance costs and have some money left over for paying the taxman and paying your shareholders and making some retained earnings. And then gearing is, are we up to here, are we up to here, or are we down to there in debt? So total debt though in AAT exams will only mean non-current liabilities, so loans, debentures and preference shares. Some people would add in payables and overdrafts to it, but they just get a slightly different number, but by and large it tells you the same picture. And some people won't put the total debt figure on either, so it's just a slightly different version, but by and large the same meaning. As long as you're consistent, it tells you the same pattern. And that's our ratios that we need to learn.